Welcome to the case review for Breeden Security A. So to get us started on this case, I want you to open your book to page 20, 21, 22. I want to talk to you a little bit about what's given in the case and some of the numbers that you have to deal with. And I also want to mention to you that you will be building on what you've already learned. So it's not a completely new situation, and I want you to learn how to do that, to apply what you've learned to something that's just a little bit different. So some of what you're going to be pulling into this case based on your prior learnings include formulas for break-even point and also understanding of multi-product environments. So like the Giberson glass case, you have multiple products, whereas the first case you dealt with just one, which really helps us simplify things and focus on certain assumptions. And then also, in addition, we're going to be dealing with elements of fixed costs again. So remember, one of your first challenges in the first case was understanding how fixed costs change when volume changes, so when you're not at full capacity. So we're going to go back and revisit that situation again. So you do have a lot to grapple with here, and you will be building on what you've already learned, which I think is cool. So starting with the very first paragraph, in the case, at the top of page 20, you're introduced to the company and you're told that they're a subsidiary of a parent that is in Germany, and they've been given a budget projection of $210,000, so they'd like to make a profit of $210,000 this year. So it's an objective of the company, of the parent, to be able to do that. And I want you to think about that. How would you take what you've already learned, what formulas you've already been working with, and apply those to being able to figure out, well, how many units do I need to sell in order to generate that kind of profit? And we kind of stopped short there with the Giberson glass scenario. We said, how many units do they need to sell to break even, and what price do they need to charge in order to break even? But we really didn't go to the next level and say, well, then how many units or what price would they need to charge in order to make a certain profit? And so that's kind of why we're picking up there where we left off and kind of turning it a little bit towards a different type of example that has different challenges. Then in the middle of page 20, where it talks about the company, you're introduced to the two product lines. So RC1 is a garage door opener, and RC2 is a newer product line that they're offering that turns on the inside lights after dark. So I would say, given what we all know about these two types of products, the first one, there's probably quite a bit of competition. Even though they say they have a high security chip that gives them a little bit of a niche in the market, and they can probably price for that, there's probably still significant competition, and if their price is too high, people would switch or opt for alternatives given the price premium for the amount of value they get. And then the second one, they're probably able to price a little bit higher because it is a unique product, and they probably have research and development costs they're looking to recapture. So generally, when you introduce a product line that is innovative, that does not have a lot of competition in the marketplace, you're generally able to price for that, at least for a while. These technologies are easily adaptable, so it's highly likely that competition will enter the marketplace if they seem to be doing well with that product line. Okay, so that's about it in the middle paragraph. They are also talking to you about various volume projections that they're hoping to make. And then in the last section, the budget section at the bottom of page 20, something else they're talking about there we haven't really gotten into yet is something called product mix. So they're telling you that they expect for this company that their product lines would sell at a ratio of 2 to 1. So they'd sell 2 garage door openers for every one of their light, turning on the light device, right? Automatic lights. They're the sensors. Okay. And then in the last paragraph on page 21, something else there really important for you to notice is that she decides that in terms of the costs, the materials that are used in the products as well as the labor and supplies will be considered variable, and all the other costs will be considered fixed. Of course, that's extremely important for you to know because you're going to be required to calculate things like break-even point and target profit amounts. And of course, you need to be able to segregate the fixed costs from the variable costs so that you can set up your formula. And if you look at the last page, you got the numbers there, and you can see that 2-to-1 ratio, 10,000 versus 5,000 units. You can see the prices, the extended sales revenue amounts, your manufacturing costs, and notice the overhead has a little A next to it. If you go down underneath those table and numbers, you'll see it's expanded, and it's talking about the different overhead costs. And supplies in that table there of $21,000, that's the variable piece that she's referring to. So the parts, go back up, parts and direct labor are variable. They're given up above. Then the overhead, you've got to split it out. So just the supplies there is variable, and the rest are being treated as fixed. Notice also that you've got selling and administrative costs. That's about in the center of the page. Those also are overhead costs. They're called operating overhead as opposed to manufacturing overhead. We'll talk more about that in a minute. I want you to treat that selling and administrative costs as 100% fixed too. And then very last sentence, overhead is allocated to the two products on the basis of direct labor hours. And that's generally the way things are done, especially at the budget phase. So you got to figure out a way to allocate those overhead costs. Materials and labor are easier to allocate to product lines because they're directly traceable, right? You can observe the materials, you can track or study how much time it takes to put together a unit, so you know the labor that's been incurred, you can trace it. But the overhead is much more difficult, so you got to come up with a technique, a system for allocating those costs to the product lines. And a lot of companies really struggle with this because it's, you might think, well, it's easy, just divide by the number of units and apply it that way. But if the units haven't incurred the overhead at those using that technique, so at an equal amounts, then you're distorting your product costs. And product costs are the basis, oftentimes, as well as competition, but can be the basis for setting prices and figuring out margins. So you want to be able to make good decisions about your product lines, and a big part of that involves how you're allocating overhead. And again, let me say it one more time, if you misallocate the overhead, if you don't use the right techniques for doing it, you may have margins that don't look right. And you may make decisions about discontinuing product lines that actually are doing better than you think, or maybe even worse, right? Just depends on how it goes. So we'll talk more about that. The next section is about cost allocation. We're going to be focusing on customer decisions though, but you'll see different ways of allocating overhead that involve tracing to various products or customers. You can apply it to anything in ways that make a lot of sense. So we'll talk more about that later, but there's your formula. $2 of overhead for every $1 of labor for each product line. All right, so just summarizing, I want you to get the takeaways, main takeaways. You need to figure out how to figure out the number of units that you need to sell in order to generate a certain amount of profit. And the root formula is the break-even formula. We're just going to tweak it a little bit. Right? So if you remember, it's fixed cost divided by contribution margin per unit. That's the break-even formula. It's in your notes again. So we tweak it by adding the target profit into the numerator. So it increases the hurdle we got to get over, right? The number of units that we have to sell in order to generate that. So it's an easy modification to the break-even formula, which is your root formula for a lot of things. So break-even formula, sometimes students don't grasp until now, at this point, that the break-even formula is very useful for figuring out a lot of things other than just the number of units you need to break even and how long it might take, so how many months it might take for you to get there. We also use that root formula for things like this, figuring out how many units they got to sell to earn a certain profit. So it's very highly relevant formula and very important for a business. All right, then that whole allocating overhead, right, is important. So we're going to use a traditional approach where we use labor as the driver for the overhead costs. Okay. Oftentimes I see labor, sometimes I see materials. Some of the more sophisticated techniques involve breaking down the cost pools into groups and then using different cost drivers for each group. We'll talk more about that. It gets a little bit complicated, but it's important. And then finally, it goes back to the very first case you did where you had the problem with unitizing fixed costs, right? Where they were accidentally including unitized costs at a certain volume, and then the volume shifted, and so it wasn't accurate for them to do that. And so what I'm going to do here in this case is modify the amount of production. So we're going to look at when production equals sales, what is the cost and the profit, and when production is greater than the sales, what is the profit. You're going to notice that when production is greater than sales, we can reduce our unit costs because you're dividing fixed costs into a larger number of units. So the profit amount actually increases. But what you've done is you've pulled costs back onto the balance sheet because now you have inventory sitting there. And you can't do that for a long period of time. You can get away with that for a little while, but you don't want to build inventory levels beyond what your sales are to a certain degree. You want to keep a buffer, but not a growing buffer. All right, so a couple things here just to emphasize. 2 products. You're going to figure out target profit numbers. Should have highlighted this right here. Allocating overhead, you're going to deal with that. And then you're going to deal with unitized fixed costs again when production equals sales and production exceeds sales. So, okay. All right, let's look at this. This is a table that helps you to understand the break-even point a little bit better and how these numbers all interact and play against each other so that you can understand that target profit formula. So let's look at this example. I just made it up. It doesn't relate to the case. I'm using this to help you understand these formulas better. So sales, same as traditional income statement. You got price per unit times units sold. So let's assume the price is $10 and we sold 100 units. So you multiply that out, you get $1,000. I'll talk about this percentage in a minute. And then we subtract from that for the contribution margin income statement, the variable costs. So let's assume variable costs are $6 per unit times the same number of units, okay? Because it varies in direct proportion, that's your definition of a variable cost, to the number of units sold. So it varies by $6 a unit, linear relationship. So that's $600. You can subtract that from 1,000, you get $400 left, that's your contribution margin, how much you have to contribute towards covering fixed costs. That's how you remember that. So you can get it 2 ways. You can subtract it in total, or you can do this. 10 minus 6 is 4 times the same number of units. Notice the units are the same here. So that's 400. All right, so now let's talk about the percentages at this point. So the way you get these percentages is you take the item in this column and you divide by sales. So 1,000 divided by 1,000 is 100%. 600 divided by 1,000 is 60%. 400 divided by 1,000 is 40%. And these rates here will always stay the same in the short term for this example. Okay, so even if the volume here were different, these rates would stay the same because you're varying based on these per unit values and the quantity stays the same on each level. So we'll show an example of that so you can see and prove that out. So these rates will stay the same. Let's go to the next line item though, because this one is a little different. So we subtract from the contribution margin the fixed costs. And I don't have anything in here because it depends on the number of units produced. And I'm always cautious about unitizing fixed costs for that reason. Because if we start changing this volume here, then this is going to change. So I generally leave it in total, which if you remember the break-even formula, we always deal with it in total. So that's how most people deal with it. Otherwise, you run into that risk of calculating a fixed cost item and then applying it to different volume. It's not appropriate. All right, so we get 300 in fixed costs, and we get 30% here by taking 300 over 1,000. So fixed costs are 30% of our structure, and variable costs are 60% of our structure. We would say we have more variable costs in the structure than fixed. Okay, and then we subtract 300 from 400, we get a $100 profit, which is 10% of sales. We call that profit margin there. And then just to review your break-even point formula, so obviously this 100 units is greater than break-even because you're generating a profit. To get break-even, we take the 300 and we divide by the contribution margin per unit, 4. We get 75 units. And that makes sense, right? That it's going to be less than 100 because we're making money at 100, so we must be over break-even. And to get that in sales, if you want to convert that to sales, you can just multiply that times the price, because look, these are the same all the way up and down. So 75 times 10 will give you 750, or you can do it this way. You can take the fixed costs and divide by this, because remember I said these rates always stay the same up here. They always stay the same. So you can divide that by 0.4, so that's telling you that the 300 is going to be 40% of this, because at break even, these two numbers are the same. They're both 300 to get 0. I'll show you that in a second. Here it is. All right, so I just changed it all to 75, and I want to do a proof and make sure it does 0 out. So 75 units times 10 is 750. There's that 750, right? That's 750. 6, which is the variable cost per unit, times 75 is 450. That's still 60% of this. Notice these rates are staying the same here. And then the contribution margin is exactly equal to the fixed costs, which is what I said earlier. So that's exactly 40%. That's why this formula right here works. Right? This is 40% of sales, so that's why you get 750 there. So either of these two approaches works to get the 750 top number. So you know the top number, you know this number, you know this number, you know this number, you got it all figured out. Right? All right, so now, given this case, what you have to do is figure out how many units given a certain profit amount. So let's assume in this example we want to make $1,000 in profit. So I want to see, when I'm done, $1,000 down here. And I know this is 300, right? So think about that. If this is 1,000 and this we know is 300 because it's fixed, then this must be 1,300, right? 1,000 plus 300 is 1,300, right? And then if you know that's 1,300 and you know this is 4, you can take that 300 and divide by 4, or 1,300, and divide by 4 to get the number of units to generate that profit. And then you know that that number of units can be pushed right up through, and then you run it out. Let me show you. All right, so here it is. Here's that formula. For target profit, you take the fixed cost, you add in the target profit. So just what I was showing you before. Take the fixed cost, add this $1,000. So that gives you $1,300. You divide that by the $4 contribution margin. That gives you $325. So let me roll that up to the top. So that $325 then is the same here. So multiply times 6 to get this. And here, multiply times 10 to get this. Now let's look what happened to the rates. These three stayed the same because they're all based on the same volume, of course, and these numbers are consistent. They vary in direct proportion to the change in volume. So those rates as a percentage of sales are never going to change in the short term as long as these assumptions hold. However, this number is now a much smaller portion of this because sales are increased quite a bit. So it fell down to 9.2%, which when I subtract that from 40, I now have a significant profit margin. So notice what happened to the percentage of monies that I'm keeping on the bottom line now that I've exceeded break-even point and I'm getting quite a ways out from it. A lot of the money that I'm generating from sales is dropping right to the bottom, which is awesome, right? Fixed costs have already been covered. Every little bit of money I make after that is going right to the bottom. All right, so that's how you calculate the number of units to achieve a certain profit. Let me say it again. Here's your formula. I should probably put brackets around that because you've got to add these together first and then do the division. And given the order of operations, you need parentheses around that to make that work in Excel. So just be careful of that. You need parentheses around that. Okay, so it's fixed cost plus target profit divided by contribution margin per unit. All right, so you're going to be working with that quite a bit in the case to be able to run out some of that. Okay. So now let's talk, because everything I gave you in the previous slides there were based on a single contribution margin. I didn't say it was a single product, but it was kind of implied that it was. I gave you the $4 there for contribution margin per unit. If you do have multiple product lines, you're going to have to take an extra step and compute that contribution margin in total. So you got to combine the product lines and come up with what's a weighted average of the various product lines. So let me walk you through a quick example on how to do that. Let's assume we have 2 products and that the contribution margin per unit is as follows. So product A, $12 contribution margin per unit, and product B, $20 contribution margin per unit. And the product mix, so you saw that come up in the case where they were giving you the mix. The product mix in this case is that for every 10 units of A that you sell 3 units of B. Okay, so you got to deal with that mix in terms of these contribution margins. You can't just add these two together. You got to weight them based on the number of units that are being sold. Okay, so here's your break-even formula again. Fixed cost, this component, it's easy because you've already grabbed them in total, and it doesn't matter how many units you sell or what the volume is because they're not affected by that. So a fixed cost component in the break-even formula is not an issue when you have a multiple product environment. It's this piece here we're going to have to tweak. So here's how we do it. For our example, we take the contribution margin for product A, which was 12, and we multiply it by the mix for A, which is 10 divided by the sum of these, which is 13. 10 divided by 13 is what you're going to weight this 12 by. So multiply that out, and you add to that product B, contribution margin, times its mix, which is 20, times 3 over 13. And when you break that down, product A contributes 923, product B contributes 462. You just add them together. So this is your contribution margin every time you sell 10A and 3B. Okay, that's your contribution margin per unit for that sales mix. All right, so that's how you work with the break-even formula when you have a multiple product environment, and you'll have to do that in the case. I walk you through that in the Excel files. All right, let's talk a little bit about the overhead allocation piece. So I mentioned some of this already to you. The direct materials and the direct labor, so that's your parts and your direct labor, are easy to trace. We talked about this already. You can see the materials right there in the product. So I'm looking at my laptop, I see all the materials. The labor is fairly easy to trace. You can do time and motion studies and figure out how long it takes for people to do the work and what it costs to do that work. So those are fairly easy to trace. There's other costs, though, which are called indirect costs or overhead costs, that are more difficult to trace because you can't see them on the unit, and you can't do time motion studies to figure out how much they cost towards the unit, because you're talking about things like utilities or rent or heat or other insurances or property taxes, maintenance, cleaning. There's all kinds of costs that are incurred that are considered overhead. And there's no real easy way for you to allocate them to product lines. So in accounting, we've developed several different systems that you can use to allocate those overhead costs. Some of them are what we call traditional methods, and they're simple. They're usually based on either the materials or the labor. I've seen it done both ways. And they're pretty simple. So you just budget your total overhead, and you budget the total, let's say labor, because in this case you're using labor. Budget both pieces, and you divide that out, and you figure out, well, how much overhead do I incur for every dollar of labor that I incur? And in your case, it told you that you're going to apply that on the basis of 2 to 1. So it must be that we've incurred overhead at the rate of $2 for every $1 of labor. That's a really simple way to do it. And it also accounts for product differences. So if labor costs are different for each product line, then it's going to account for some of those differences, right? Which is better than just dividing by the number of units, the total number of units, and allocating overhead that way. Right? So the problem, sometimes students gravitate to that. That's like their first answer. Oh, just divide by number of units and spread it out over the units. The problem with that is not every product line absorbs those costs in the same way, in the same fashion. So you need something that's a little bit more specified. And labor is at least a step closer. The more sophisticated techniques involve taking the total overhead that you treated as a bucket in total, and you break it down into similar costs. So in other words, costs that kind of behave in the same way. So some of them might relate to, let's say, taking care of the machines. So machinery depreciation, maintenance on the machines, supervision for different machines. Those costs maybe could be pooled together, and then you divide by number of machine hours. So how often are those machines used? So that might be one way to kind of take those off and divide them out by something that's more meaningful for that cost pool. Whereas other costs, such as facility-related costs that apply to maybe everything, for instance, heat, insurance, property taxes, those kinds of costs that are not as close to the manufacturing process, they're more general. Those costs, maybe you want to divide by square footage for each product line. So total square footage, and then each product line takes up a certain amount of square footage on the shop floor. Or different techniques that make sense for your organization. So there is no right or wrong way to apply overhead. Obviously, the more specific you get, the more you divide up these into cost pools and track different cost drivers, the more complicated it gets, and the more room for error. But the more specificity you have in the way you allocate the overhead, the more detail you have about your product line performance, the more accurate it is. So you got to think about that trade-off between accuracy by being more specific and the cost of doing so and the room for error. So anyways, I diverted a little bit there on overhead techniques, but that's one of the issues that comes up in business a lot for people. And it's not just accountants that grapple with it, but product line managers, manufacturing operations, and marketing people, because it drives prices. Costs, to some degree, drive prices. So it's all interconnected across the organization. Okay, so just making this other distinction here. Overhead can be grouped into two general categories. That's related to manufacturing. So we take all those costs that can and do have some relationship to manufacturing, and those that don't. And so we're going to call the manufacturing costs MOH, manufacturing overhead, and we generally take all the other costs that are not manufacturing, we put them in one group called SG&A, selling general administrative costs. And those are also treated as overhead. All right, so here's a traditional income statement. Cost of goods sold is going to contain the direct materials and labor, which we've already said in our example for this case are variable. And we're going to add to that manufacturing overhead, and that piece includes both variable and fixed cost elements. In your case, it's stated that the only variable piece you have to deal with is the supplies, and all the rest are fixed. So that makes it easy for us. We don't have to do a lot of work there. And then she also states that the selling general administrative expenses are 100% fixed. So there's no supplies in there, no details of that. So you can assume that that's 100% fixed. All right, so getting this formula here, sales minus cost of goods sold is gross profit. Gross profit is the profit at the product line level. So it tells you how much money you made on your products. So that's why we need to distinguish overhead costs between those that pertain to manufacturing and those are other. So if it's not manufacturing, it's considered SG&A. And we split that out so that we can figure out how profitable are we at the product line level. Okay. That's a number we compare with our competitors to see who or which of us are making more margins, we're more efficient at that level. Okay, so SG&A, it's your advertising, promotion costs, human resources, accounting, headquarter costs, and it can include both variable and fixed components. So you can have commissions as part of your selling costs for your employees. Your sales employees can be paid a commission based on volume. That's obviously variable. In our case, we're assuming all of the SG&A is fixed. It just makes it simpler. We got enough to deal with. All right, so you're going to take those manufacturing costs, those overhead costs, and you're going to allocate them to the product lines based on direct labor. So that's what the instructions said. Your direct labor for RC1 was $35K, your direct labor for RC2 is $21. Add them up and then use the proportion of each. So RC1 is 35 over 56, RC2 is 21 over 56. That's 62% of the overhead costs are going to be absorbed by the first product, and 37% of the overhead costs are going to be absorbed by the second product. And that will impact our profitability. That's where we're going in the second case. So we're hitting this in little steps. Okay, then after you do all that, you've got to do what I had mentioned earlier, using that break-even formula and adding in your target profit and divided by a weighted contribution margin per unit. So if you have a ratio of 2 to 1 for RC1 to RC2, that's 2/3 and 1/3. So 67 and 33. So you got to make sure you apply that. And I walk you through that in the spreadsheet. So if you're thinking about it using the formula and you're doing break-even point, in your example you have $131,000 of fixed costs. That's what you should get. That's your checkpoint. And when you divide that by your CM, weighted CM, so there's a checkpoint for you there too, you get roughly 13,000 units. And then you got to spill that back out based on the product mix. So 2/3 of those would be RC1s and 1/3 of those would be RC2. These are approximations. And then the prices were given for each product line, so you can multiply the price to get sales. And again, I'm rounding here, and your Excel will do a better job at that. With target profit, you just take your fixed costs, which were 131, there's your checkpoint, and you add to it the target profit per month for the first one you do, which was 20. So this is 151. And then again, divide by the CM per unit, it's 1007. You get 15,000. Roll it back out, 2/3, 1/3 to get your product mix for each product line. Okay. So last but not least, you got that whole deal where you have to deal with the fixed costs. And production equals sales, you don't have any inventory left. So you have zero inventory at that point. And 100% of your costs are therefore on the income statement because of that. So there's pros and cons. One, your profit will be less because you haven't built up any inventory, but your balance sheet will be very lean. You won't have a lot of inventory there to cover. In part 4, you go with a little bit more realistic scenario of, you got to be careful here. Production is a little bit greater than sales, so we're building up some inventory. And the benefit of doing it in this case is that you're able to spread the fixed costs out over the production volume. So your unit cost goes down, making your profitability on your income statement go up. And the difference in the cost is found back on the balance sheet. So those extra costs that you had expensed under part 3 are now being held back on the balance sheet. So you look a little better on the income statement, but you now have inventory that you've got to track, maintain, insure, inspect, make sure it doesn't get stolen, so you got to store it. Maybe you got to have environmental controls of some kind, make sure that there's no humidity problems depending on where you are, or cold problems, and so on, right? So you got cost of holding on to and storing inventory, as well as obsolescent issues. But you can't do that forever. So it's okay in the short term, you want to build a little bit of buffer inventory. Obviously, you should have some buffer, but you should be operating as lean as possible. So that's one of your strategies with lean is you produce on demand. Customer places an order, you build it, and you fill that order, and you don't really stock inventories other than some raw materials that you need to be able to fill your orders quickly. All right, so you're going to have to deal with that. I think it's a good example for you to get a better feel for that. That's really all I wanted to say to get you started. Hopefully it's not too long a video, but gives you lots to think about and lots to consider. So good luck, and let me know.